Now I am coming to a very, very important part in this diagram, right? That is, I will put, I'll just I want to draw one big circle in red color here, and let me to remove what is written on the top. And remember, this circle is going to be a major learning and major concept that we will come across. So there is a big circle here, right? And also I am going to take this RMM out and to say that there are two types of RMM, right? If for MCQ question, what are the two types of RMM? One is here, and that is called inherent risk. So then what is inherent risk? Now, very, very important. Now if you look at our notes, and I have put some notes here, 1, 2, 3, and if it is 3, this should be 4, and then I will write here note 5, what is an inherent risk? It's very important, and you will understand in a while why I am now only coming to inherent risk. Now there is a word called risk of material misstatement here. There are two types of risk of misstatement. Before I am drawing this diagram, I am telling you, one is an inherent risk, the other one is control risk. You may already know that, but at the end of this video you will understand to what level you actually knew, and that may be incomplete, right? So what I want to say, when you say inherent risk, now these risks we can divide one part of that as inherent risk. The inherent risk is, I will again read a book definition to see whether you understand. Inherent risk means what? Susceptibility that an assertion can be misstated. Now see, the word assertion comes. Now if anybody read this definition, I will read it again. Susceptible, now you don't know what is susceptible. Susceptibility looks like a big word, but very simple. Susceptibility means, let me to write here so that you understand, right? But this thing I write and erase. You can also go to your note and write. So inherent risk means susceptibility that an assertion can be misstated. Now see, if you don't know assertion, you can't read this. Susceptibility means simply you can write possibility that an assertion can be misstated, but there is another part in this definition which is important. So I write in different color, susceptibility that an assertion can be misstated without considering control. That is very important, without considering internal control. Now then you will understand in a little while what this means. I will take example. What is the possibility that an assertion can be misstated, right? Without control is the book definition. First of all, like we learned the word assertion, literally means dictionary meaning. What is the dictionary meaning of inherent risk? Inherent, the word inherent, it's there, you can't avoid. If you are living close to the sea, there is possibility of things like the exposure to tsunami is high. If you are living close to sea, there is an inherent risk of such exposure, right? And if somebody asks, I can take an interesting example for inherent risk, right? Inherent risk. Take COVID. The possibility of getting infected inherently high, because where now I am, in this case I am not using a mask, right? But if I go out to a public place or a wedding, the possibility, inherent risk means I am saying what is the possibility of COVID infection is very, inherent risk is very high. Whether I have a mask or not, inherent risk means we are telling, usually if I take diabetes or something else, there is no inherent risk like that. That depends on many other factors. So the inherent risk means by nature that is complicated, that is difficult, that is inherent risk. That is why possibility that an assertion can be misstated don't worry whether you are controlling or not. Whether I have a mask or not, irrelevant. What is the chance of COVID infection? Generally high, right? Now then, whether mask is okay or not is a different matter. So therefore, remember, in inherent risk definition, we don't take control into account. Why we want to account? Auditing standard says there is auditing standard for all of this, and that is a very fundamental auditing standard. I will write this name also, auditing standard number 315, right? So when it comes to inherent risks, we don't look at control. Why? We want to assess, measure inherent risk without control, because control risk will come separately. I will write it somewhere here. Now you understand what is inherent risk. I will erase this definition, you can write it, and I will take examples so that you understand it very well, right. So this is very important. Next 10-15 minutes explanation is going to be very important, right. Okay, inherent risk. Now I go back to my export company. This will come to you as a case study later, Ridma's PLC case study. Now the export company that I mentioned to you, I will also use this side of the board so that I can utilize the space properly. There is an export company called Ridma, and then there are revenue. I am talking about, see, one transaction, that is sale. Not one, I am talking about sales. And now you need to understand, doing an audit means you have to assess the risk before you audit in. Otherwise you are just blind and auditing whatever whatever you think important, you audit, right. But auditing standard says you go and audit the big ticket items where things can go wrong, rather than auditing little things. That's why you have to audit material things which are important, high risk. Now I take the example of revenue recognition of this company, one of the company, right. I mentioned to you in the name Ridma, because I am going to give this case study so that this is the big picture main session and you will be able to connect this. If I am talking revenue recognition and this company, and this, let's say this is the factory, and then from this factory how sales are made. Sometimes when the goods are going, okay, they raise an invoice. At the time of raising the invoice, your general ledger is updated, and then similarly at the same time they may do the dispatch, we don't know. So there is a dispatch point. Now dispatch means goods going out. Now see, these goods are normally very often given to a carrier. There are forwarding companies, right. So we will say handover. HO means handover to forwarder, right. And then after that, goods should be on the vessel, right. Vessel, and goods are sailing. I can row a vessel and it's sailing, right. You can say goods has to sail. But for your purpose, remember this documentation is very important. Now when there is a dispatch, there is a dispatch note, and then when goods are handed over to a forwarder, there is a forwarder note, forwarder acknowledgement or forwarder note, let's say. And remember, if it is goods are on the vessel, at that point there is a document raised, and that is called bill of lading. Very important document in international trade, BLL, right, bill of lading. What I want to say now, there are sales that has taken place, and this company has several customers, right. Say if you take main customers in some customers in US, the shipping terms, we call this international commercial terms. Some customer shipping terms is FOB which means when the goods are on the vessel only you can recognize revenue, and that is where according to the standard if you apply, because I told you misstatement means you have to apply the relevant SLFRS. SLFRS 15 says revenue has to be recognized when the control has passed. Earlier regime is risk and control. When the risk and rewards are passed, but the new standard says at the point at which control is passed. The standard has 5-step process in revenue recognition. Now I am scaring you because you have to know accounting standard. So there is a 5 steps process of revenue recognition under SLFRS 15. There has to be a contract, then you have to determine the price, performance obligation, allocate all of that. But what real point for revenue recognition is the point at which control pass. So the control pass depends if it is a 4B contract at the bill of lading date. And there is another contract when you hand over goods to forwarder. Those contracts are called, now these terms you should have learned even in your previous auditing paper. These are basic things you should know. FCA contract, right? That is where goods are handing over to a forwarder. And then I will also tell some shipment terms says ex-factory. Ex-factory means the moment goods are going from your factory, you can record the revenue. So that is a dispatch note point. Now if I tell you, as at 31st March, this company has recorded 10 million invoice, and if you really look at that 10 million invoice, the shipping term is FOB, but they have booked this 10 million as a part of, I mentioned to you 900 million revenue. There is 10 million they have booked as at 31st March. Now, can they record this as 31st March? Remember, 31st March is only the invoice date. And you may also find goods are dispatched 31st March and given to the forwarder on 2nd April, because forwarder has come only 2nd April and this vessel is actually sailing on 10th April. Can we record these sales in the month of 31st March? No, the shipping term is FOB, and I said it's a FOB contract. Sale can only be recognized based on the bill of lading, that is April. Therefore, there is a cut-off risk, right? So, cut-off risk. See what assertion is wrong? Cut-off. Why I took this example? Now imagine this company has several contractual terms like CIF, and then revenue recognition is not simple, it is complicated because there are multiple elements of multiple terms. Because there are multiple terms, unless somebody is comparing every invoice with the shipping documents. I write the word because these are called shipping documents. Unless somebody compare invoices with shipping documents, they are not able to, correctly recognize revenue, and that is what I want to say. Therefore, in this company, there is an inherent risk. Revenue may be misstated. Now remember what inherent risk means. Possibility that an assertion, in my example, cut off, right? Possibility that an assertion can be misstated whether they have a control or not. There is a high possibility. Why? That is because of one thing called complexity. So therefore, when you want to discuss whether there is inherent risk, I use this word tukums. There are 5 features. Even in exam question you can remember these 5 things, and very easy when you are doing a case study. If any one of these are there, you can say there is inherent risk. So what are those? 1 is complexity, 2 is complexity, there is another C I will explain to you, change, and then 2C is U is uncertainty, and then M, please write that M I am writing management bias, right within bracket there is a fraud risk in a company, that is an inherent risk, and then some balances are subjective, subjectivity. When these are there, we usually say inherent risk is high. Now in my example, you can easily write, if there is exam question given this case study, you will write one answer, you will write in the exam. If examiner says identify risk, you will write there is a possibility, right, that sales cutoff may be misstated because one word, the word is complexity. Why? Company has multiple. Now what? Multiple shipping terms, therefore each invoices need to be compared and then only you have to recognize revenue. Therefore it's complex. Right, so I don't explain to you all of other things now because this is our first session, right, but I will explain to you a few of them in detail, but I take this as a main one, complexity. But let me to quickly tell you what others also means. The change, now this especially, this change is usually in some businesses there are a lot of changes that is happening, right. Now there are new customers that are happening and they are going to e-business suddenly. Now see, all this is there, but they suddenly started selling via website. Then at what point they have to recognize the website is a change. Now usually, let me to write here, now see what is in the accounts are, result of business decisions. Now what should be on the top is business objectives. Every business has business objectives, right. Now business objectives to maximize the revenue and they are going for a digital business model, and that is a change. And remember, usually these type of changes we call business risk, right. So what I want to say now, please write my example. One of the business risks is change into e-commerce. Now when there is a change, business risk means those risks which are inherent in the business, but in auditing standard there is a definition to say business risk arises from the change. Like I said, company is going, now COVID is a change in the business world, right. Change, action by the company or inaction or inappropriate strategy, business fail, those are business risks, right. Now these business risks also come in and affect in, now especially this change, and some businesses are inherently complex, the complexity comes. Now good example, if you remember, there is a company, there was Touchwood. Once it was a very leading company. See, Touchwood is all about very complicated business, and as a result, now valuation of biological asset, all of that is complex. Biological asset tree valuation, right. Now similarly at inherent risk we will see uncertain. Now say there is a legal case where settlement is not sure, inherent risk is very high. Management bias comes, whenever there is a chance of fraud. This company, the managers are getting bonus based on the sales target, that is why they are changing the sales, and those if you identify things like targets, commissions, and those are fraud risks. And especially subjectivity comes, right. Subjectivity as well as uncertainty both can come in accounting, in balances where there is a fair valuation. Fair valuation is a very complicated thing. You would have heard about financial instrument, derivatives, investment property valuation based on discounted cash flow, all these various methods, share based payment valuation. These are usually fair value and estimates. Even my example of impairment, these are what? Very subjective, and also there is uncertainty. Now whenever these words, even in the exam you can use these words to explain inherent risk. Now I want to get to another important point, that is, I am taking my example, let me to write my example. Now in this case I am writing my example, so which means I am identifying a risk. Right, I am identifying a risk of misstatement. I am identifying a risk of material misstatement. Now see, in the exam question also like this, you will write. So my risk of misstatement is, right, there is a possibility of, misstatement of revenue due to complexity. So why there is a complexity arising from multiple shipping contracts, shipping terms, multiple shipping terms. Within bracket we can say FOB contract, FCA contract, Annex factory, and so on. So now there is a risk. Remember, when there is a risk, company will not sleep, because company CFO knows that the revenue can go wrong if they don't match each invoices with the relevant shipping terms. Therefore, there is a circle here, and that circle is what? Let me to use another black color. That circle is how company is going to protect against the risk, and that is called control activities. You know, companies can have control. For the simplicity, you can say it's control activities. I want to give you several examples of control activities, and the meaning I'll write within the circle itself this word control activities, because I want to write, okay, what are the controls that company can have in this case, right? Let me to use another color. There are several controls company can put in place to ensure that they will record revenue properly. Now these are control activities. I'll write about 4 control activities so you understand. Now before I write 4, you have to tell me that if company wants to avoid this risk of, you know, this 31st March sale, you know, if you only look at the invoice, okay, there is 10 million, but if you compare the invoice with the bill of lading, you can't record it. Cutoff is wrong, and this type of control is called reconciliation. Now these are the control. Reconciliation. I'll write other control meaning, please write with me. If somebody asks what is the heart of control, the answer that I am going to give is SOD. And if you look at, especially in your chapter 2, chapter 3, you will see SOD is everywhere. What is SOD? Imagine in this company there is only one man who can dispatch, who can invoice, who can collect money. He can do anything, and you know, a lot of frauds can happen. That is where we say there has to be a segregation of duty when it comes to authorization, recording of transaction, and custody, right? So that is segregation of duties, a control activity. Reconciliation, right? And then there should be physical control to ensure, now this finished garment, we have to ensure nobody will steal. The physically protected assets are protected. And another important control is authorization. Now to make sure all the sales, only genuine sales are recorded, every sale invoice or should be authorized by the manager, and these are called control activities. Now see the word control activities, and sometimes management will go through various sales report to make sure sales are okay. Those are called business performance review. All these words you will come across when you read your chapters. Business performance review, right? Now there is a control. Another point that I want to tell you, now in this company, now there is accountant who is supposed to compare. His job is to compare, to reconcile, right? Reconciliation is also comparison. Compare invoice date with shipping documents. Shipping document is bill of lading. Now we recognize that, you know, sometimes this accountant is not doing this or taking a wrong report and doing this, which means although we see there is a reconciliation, either we are going to say this reconciliation is, you know, it's wrong. By designing, the reports are wrong. Therefore now note this word, when it comes to a control, we have 3 things to check, then only this circle is really protecting against inherent risk. Control is designed properly. Control has to be designed and it has to be implemented, right? And then it has to work continuously, and that's called operating effectively. operating effectively. Now I told you three things about a control. Now what is the control we are talking about? A reconciliation. Right now, okay, before this example, later I'll explain to you this in more detail. I said at the start, if this you will understand 60% of this video better, because this is going to activate your curiosity and to learn more in next few videos in depth, right? So what I want to say, when it comes to control, now see this warehouse, there is a lock. Now although there is a lock, anybody can break the lock, and by design the lock doesn't work, ineffective, right? And then there is a good lock now, but the door is not locked, control is not implemented. Operating effectively means every day this has to work. Now although there is a good lock, some days door is open, it is not operating effectively. So these three concepts also remember. The purpose of this lecture is at the end to know the audit vocabulary concepts, and you understand broadly maybe 60%, but as you go through the chapter in detail in future, all other sessions, you can refer back to this session and make sure you will feel that you really understand. Because without such an introduction, if I just do something, you will not get the essence. So therefore you may watch this video for several times so that you understand all this concept and write in a piece of paper. I'll also show that paper to you, that concept that you learned from this session. So control has to design implement. Now this accountant, sometimes he has downloaded wrong dispatch note, wrong bill of lading. That means by design is failing, and some months he has not done the reconciliation, right? It's not operating effectively, which means now we are saying, although there is a circle, the circle is breaking and leaking, and there is another risk created, and that risk is called control risk. So the control risk is what then? Control risk means risk that an misstatement at assertion level, again the word assertion level, right, will not be three things: prevented, corrected, detected or corrected by control. Right, okay, there is a definition you can read. I'll show you in the definition, but again the message: control, the lock cannot handle the risk, which means if there is a control, the control should be able to prevent the wrong sales. If there is a problem, detect it. If 1 million is detected, correct it. So preventive, detective, corrective, the control doesn't work, and that is control. So now you have learned what? So let me write here, you have now learned assertion level risk. Now you have learned, if you take, I mentioned to you, when it comes to ROM, risk of material misstatement, remember there are two big classification, that is, one is called financial statement level risk. This we didn't come yet, it will come very soon. The other one is assertion level risk. So assertion level risk we learn as inherent risk and control risk.